Well, the stock market's raging and the traders all shout. There's one man we're watching, his moves full of clout. Some call him evil, some call him foul, but I just smile and call him Daddy Powell. Wield your own power, nuke the market again. With a flick of his wrist, make
in a fight. Who knows if we'll feast or starve come the night. With a glance at the screen, I let out a howl when I see that old motherfucker, old Daddy Powell. Oh, Daddy Powell, oh, Daddy
Folks, we are back at it again, and I have to admit, can I share a secret with all of you? Going into me clicking the start of today's stream, I was thinking, okay, cool. Be realistic. If you guys were there in the morning, you know that my systems had a little bit of a weird issue where the strategy number 3 fired in place of number 2, and 2 came in 3, and there was a big mix-up. So basically, it punished me on my Apex eval accounts. Tradeify is fine. The pros on Take Profit, or maybe it's the other way around, on whatever it is. The Apex is the one that took kind of a hit. And now that I'm thinking about it, if I'm being honest, I was sitting there and I was like, okay, cool. Don't trade on FOMC days. FOMC days suck. Don't do it. It's not worth it. And that's how I was feeling. That's how I was feeling literally up until I hit that song. And then listening to that, I was then wondering, I was like, should I just try to punt these Apex accounts across the line? Like, I'm really, all right. So like, this is a two-parter. A two-part question is, there's a very, very good chance that at the 2 p.m. announcement, there's going to be enough of a movement that either the Bulls are going to hit it or the Bears are going to hit it. There's a very high chance of that. Unfortunately, there's not enough time left for me to double up on the amount of accounts. So I can only pick one direction. I either have to pick like, yes, the Bulls are going to win, or yes, the Bears are going to win. And the last time we did this, you guys were spot on. You guys told me exactly what to do, and I did it, and it crushed. So I'm going to turn it over to you again. It's a two-part question. Part 1. Do you think I should just stay away and not trade, or do you think I should actually trade this and try to like get them across the line? Going into this, I wasn't going to really take any directional trades or this or that. Like, obviously, I'm still mostly interested in getting the system to work. So question 1 is, do you think I should be a good, disciplined boy and not touch it, or do you think I should just fucking send it? That's cats win, trade puts. I'm not doing that. Yo, stay away, 10 short, trade it, do fall, stay away, never ends well, full sand, sit on your hands, trade it, stay away, send it, trade and go long, degen, activate, trade it, be disciplined, trade it, no discipline, risk it for the biscuit. Okay. Be a degenerate. All right, well, let me put up a poll. Which way first? All right. All I need, like literally all we're trying to do is guess the first impulse. I'm talking from like 2 to 2:05, and not like 2:05 as in like 5 seconds. From 2 p.m. to 2 p.m. in 5 seconds is what I'm asking you for. Which way do you think the very first impulse is going to go? The very, very first impulse. I just put up a poll. I need you guys to vote. 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 Do I want to do this? Do I want to do this? Do I want to? This is a decision. This is a decision and a half, team. Some would say it's a decision and a gazillion. Oh. All right, you guys are voting. Kev's straight out. Shit, I need to change my vote. Oh, man. Oh, man. So here's the plan. Here is the plan. The goal is whether you guys pick bullish or bearish, I'll trade it in that direction. Exactly at 2 p.m. right here. Right here. 2 p.m. This white vertical bar. Right there. I'm either looking for a 16-point bounce up, which would be all the way up to, well, geez, that's a tight range. So I either need 16 points up or right here, or I need 16 points down. Like, I just need to know what the first reaction is going to be. So basically, wherever we are at 2, do we think the first bar is up, just that first jolt, or do we think it's down? No change. There's definitely going to be a change. 100% there's going to be a change. Sideways, these are the dumbest bets ever. If you think it's going nowhere or sideways at 2 p.m., that's a dumb bet. It's as if you've never watched an FOMC announcement reaction. The probability of it going up or down 16 points at minimum is like 99% chance. The sideways bet's the dumbest bet. I didn't even allow you guys to do that as an option. That's how dumb of a bet that would be. Down, strangle. Why would I play? Dude, you can't play strangle on futures. What? I feel like you guys aren't even taking this seriously. I feel like you guys are just saying dumb things to make me angry. Play a strangle, stupid. Sideways, stupid. These are all horrible. Your option is either it's popping or it's dropping. That's it. Out of all of the potential things you could do, I've boiled it down to 2 solutions for all of you because I'm that nice of a guy. It's either a big pop or a big drop relative to this 1 minute bar. All I need is either 16 points up or 16 points down, which that size is very likely. What's a 50-50 shot is either up or down. Oh, popping. Generally, the way to play this would be buying the double amount of the accounts that you need. And then from there, buying the double of the accounts you need and then just playing half long, half short, and you get them. You guys aren't as confident in this bet as I thought you'd be. One of the sides is winning to the tune of 60%. Here, I'm going to turn off the poll in 30 seconds. I'm turning off the poll in 30 seconds. So vote, 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 vote. Vote, 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 vote. Vote, 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 vote. Okay. All right. I'm turning this poll off. End poll. Pick your nose and play the color, green or red. That's an interesting way to approach this problem. Interesting way to approach this particular problem. Here, let's get our boy up, Rick. Let's get our boy Rick up. Remember, Powell actually starts speaking at 2:30, but the announcement comes out at 2, and the market is 99% confident that we're staying at 4.25%. 99% confident. Here's this guy. All right. Everyone get ready. Wait, what was the result of the poll? 60% bullish. Risk it for the biscuit. Dude, I'm actually kind of nervous. I don't know why. Why am I nervous about this? Because it feels stupid. All I need is either 16 points up or 16 points down, but you guys voted up. You guys voted up. As in, I just needed to get to like 54. It just basically needs to barely take out this intraday high. This feels dangerous. This feels dangerous, folks. This is feeling dangerous. Oh, brother, 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 oh, brother. Oh, brother, oh, brother, oh, brother, oh, brother, oh, brother, oh, brother, oh, brother. We're in the game now.
Order submitted.
Which way is it going to go? Is it not released yet? Is it not released? Where the fuck is it? Why are we not? Is the data not out? Go. Just go. Just go. Just go. Just go. Just go. No. No, you're right there. You were right there. No. No, you were right there. Bro, you were right fucking there. You were within a point. You were just within a fucking point. You hit. Oh, go. You were right there. You were right there. This is no. Stupid. Fuck you. This is stupid. Are you fucking kidding me? How can you get within a point? Fucking horseshit. Are you fucking
Order
kidding me?
filled.
Fuck this. Fuck. Are you kidding? Are you fucking kidding me? A point? A fucking point? Fuck this. This is such horseshit, dude. Oh my God. A point away. No. A fucking point. That's fucking insane. I guess bearish was the option. Yeah, the initial, it went from 32 to 60 down to 10. Fuck. Son of a point. Fucking a point. A fucking point away. A point. Unbelievable. Unfucking believable. What do these fuckheads have to say about it?
Amazing Fed survey. Steve Leishman, we know you got to get into the lockdown. You're going to get that question in.
Divided
really look
Fed
forward to it,
holds
Steve. Great stuff. Thank you very much.
interest
Get back
rate
now
steady,
to our
defying
panel
Trump's
on this. So we got
demands
what
for
we expected,
aggressive
Francis.
cuts.
We got no cut.
Perhaps
Okay,
it's
we
because
got
he
two
doesn't know what he's
dissents
talking
from Fed
about.
governors, first time since 1993. Before you were born.
It was a 9-2
even.
vote.
Okay,
I wish.
This dissent happened. What is Jerome Powell going to do at the next few meetings? Because he's on his way out. And his legacy is, I don't want to say
point.
on the line, but what he does is kind of how we're going to remember him, because that's how things work.
I'd like to
Point.
take a step back and say there's so much focus right now on Chair Powell, the individual, as if we remove Chair Powell, that's suddenly going to change dramatically the path of the Federal Reserve ahead. I'm going to put forward that actually it's the data that's going to determine dramatically where the Federal Reserve
As Steve
goes
just said.
next. Exactly. And the issue is for Chair Powell is we may not have full clarity even by the end of Fed Chair Powell's term on what exactly is happening with tariffs in this economy. I do not think we're going to be able to see by September how tariffs are infiltrating inflation. It's probably a late 2025 story. And at the end of the day, this is going to come down to, is it a demand destruction story? Is the U.S. going to slow down materially? Then you can have big rate cuts. Or is there a lot of inflation? And that is not related to who is Fed chair. That's related to the economy and trade policy.
Brutal
Okay, Jim,
bad
I'm
beat.
looking here at the CME Fed tool, Chicago Mercantile
What a
Exchange. You can see it on my computer.
brutal
Dave, you're
bad
just going
beat.
to have to trust me on this one, all right? But it shows a 60% chance of a 1/4% rate cut at the September meeting and a 38% chance of a cut by the October meeting. Do you agree with that?
I can't.
I think it's a fair assessment,
I'm in
right?
fucking
But I think
disbelief,
what we have
folks.
to
Just
do,
the market's aggregated
it's
data.
the market's assessment. Right? So the way I
such
think about this
disbelief.
is that we have been waiting for the impact of tariffs to hit the markets in terms of inflation, in terms of jobs, and we've been kicking the can down the road. We've got a couple of months to figure this thing out, and every month that goes by that you don't have higher inflation, that you don't have a worsening labor market, it creates a diminishing effect that the
Disbelief.
tariffs
It's gonna
are going
come
to be
back
as
and
negative
go
as people
anyway.
think. Now, there could be a cliff effect, but I don't think it's a cliff effect where all of a sudden you
What's
wake
a
up.
cliff effect?
Meaning, like, all of a sudden you wake up one day and you realize, like, okay, inflation
Gambling
suddenly
sucks,
arrived
dude.
here. It's
Tell me about
usually
it.
a progression. This progression
right.
towards higher inflation may
We're
be
getting ready
happening
now.
right now.
Look at that
But the rate
bar,
of change is
dude.
going to matter a
Up,
lot. How
down.
quickly is inflation moving higher, and how quickly is the unemployment or the employment situation deteriorating?
Yeah, and I think the inflation numbers are going to get a good deal worse between now and the September meeting because we've got two reports. What's happening is we haven't any historical experience of tariff increases of this magnitude. And by the way, by Friday, we think the aggregate average tariff rate is going to be close to 20%. So that's an enormous increase since the start of the year. What we know is the tariff revenue is coming in. So what that tells you, and we know that import prices aren't changing, so that tells you it's not being paid by foreign producers. So it's either going to hit corporate profits in the US or it's going to hit consumers. My bet is eventually most of it's going to hit consumers. And I think
Probably.
that's going to become clearer over the next few months, which makes it harder for the Fed to justify any rate cut in September.
So you're pretty squarely in the tariffs are going to be inflationary in some way camp.
Yeah, they will be inflationary. The problem is, and the thing that I think people aren't focusing on is, if you look at that big, the OBBBA, that has got a lot of fiscal stimulus stuck into the first half of next year because of income tax refunds. So you're going to get this big wave of sugar hitting the economy in the first half of next year. So if you get higher inflation at the end of this year because
Although
of tariffs,
swings
that could be
never
sustained into
continue
early
to
next year because of
affect the data, suggests that the
reconciliation bill.
growth
So why do you want to
of
cut rates
active
now?
monitoring
I mean, we're supposed to be trying to get
first
to
half
2%
of the
I don't
year.
know, but I'm sorry. I'm having a flashback to a couple years
voting
ago.
again,
We had this
or-
something happened. We had this massive inflationary shock.
Voting against
bunch
this
of
action were
stimulus
Michelle Bowman
thrown at the
Waller, who preferred.
I don't know if you remember that. A couple years ago,
exactly.
something happened.
Yeah, something about
and
supply.
now we're talking about this great potential
Kugler didn't
inflationary
vote.
shock. And maybe actual stimulus. Josh Hawley of Missouri was actually floating the idea of direct checks to the American people. How do we know what's going to happen with inflation, Francis?
Well, I think you've hit the nail on the head here, which is
Who can afford nails?
We're so focused on what is monetary policy doing when the elephant in the room is that fiscal policy is dominating this economic cycle. It used to be, what is the Fed going to do was going to determine are you early, mid, or late cycle. Now it's government money. And that pandemic stimulus that you're talking about, guess what? It's still
Fed
in
holds
the system. The
rates
government is
steady, but two
substantially larger
officials
than it
back
has
a
been
cut.
historically, and it is
Dissents
keeping a score
highlight a
under
fraying
how weak the
consensus
economy
among
can get,
policymakers
but it's
who are
also
debating the
creating
effects
underlying
that
inflation.
tariffs
So I
have
don't
on the
even need
economy,
tariffs in order to be worried
economy
about
and
the
inflation.
inflationary path and knowing it's going to stay above 2%. Tariffs or no tariffs, you're still having an inflation problem in the United States.
Let's look longer term. If there is a one-time price change, it's just a price shock, does that become inflationary? Or do we move into 2026 with business investment, accelerated depreciation, and potentially higher productivity? And let's look at wage inflation. I think we need to look at wage inflation to see if this inflation is going to stick around. If I look at the
It's
tips
gonna
market, if I look
pop
at
right
break-evens,
back to where I
things
needed
look
it.
relatively stable.
It's going to
somewhere
hit
around
60, 61,
2.4
and I would have been
2.5%
fine. Son
inflation.
of a bitch, dude.
That could be something that's in store for us, but it doesn't seem like the markets seem to be looking past this.
But also in
Dollar's
general, the other
dropping a
side of
little bit.
Washington is just
What's weird is
piling
so is
sugar into the
Bitcoin.
economy, and that means the Federal Reserve actually has to be a little bit more hawkish. If they have to be the tough ones because it's the deficit's going to go up next year. It was already 6% of GDP in a full employment
S&P
economy.
500
and we're gonna push
maintains
up to 7.
gain.
So
Post
we're
Powell
gonna
Fed
do-
decision as
were
traders
the
wait
def leopard
Powell
in the economy a
comments.
couple years ago. They were pouring sugar on everybody.
Well,
They
it's-
kept
yeah,
rates too low for too long.
Divided Fed holds key
stimulating
interest
so-
rate, blah,
and
blah,
he
inflating the balance
blah.
sheet, buying mortgages.
And lower,
Waller
Fed rate
and
cuts, lower
Bowman
rates will
voted
push up
against
asset
it. They
prices.
wanted
don't
a
actually
25
help the economy
bips.
that much. We need stable inflation for that.
You're a good Michigan State grad. You spent a lot of good time in Lansing. So let's talk to our friends in Michigan. There's a lot of people that are watching right now around the country that are saying, darn it, Sullivan, or as the Canadians may say, for Pete's sake, right? I don't care about the Fed. I want to buy a home, and I'm waiting for mortgage rates to go down. I'm looking at the CME rate
But if the
probability
current
for 1
muddle
year from now.
persists.
And it shows a
So basically,
strong
they need the
likelihood
economy to get
we'll
a
be
bit
1%
weaker for them to
lower
actually cut.
than we are now. Do you think, Jim, that in a year or ish, We're going to see borrowing costs.
Data that continues to unfold along the recent pattern can make it very tough. If it's not bad enough to make it a slam dunk cut, it is good enough to declare a victory.
Yeah, so I'm going to push back against that. I don't think that the long-term rate around the 10-year rate, which is going to matter more for mortgages and for car loans and things like that, is going to really go down materially. I mean, we've even seen the 10-year yield has been around the same level.
It was the first meeting since 2020 in which more than one Fed official voted against Powell.
But the longer term,
it's the first since 1993 in which more than one board governor dissented.
I also don't think, as David's talking about this, the sugar rush, and thanks for the Def Leppard, quick analogy there.
You're very welcome.
Of course, some sugar on me, but but
I have a photograph as a
12
memory.
regional bank presidents.
So I don't think that necessarily generates as much potential inflation as long as you get the productivity and wages and wage inflation stays relatively contained. But this is what we don't know.
Yeah, but also we don't want to bring mortgage down too low because that's just going to push
Mag 7 Delta flow looking good. S&P 500 Delta flows picking up.
Too long. That caused an enormous bubble in home prices. The thing that's unusual today is not mortgage rates. Mortgage rates are actually lower than they've been 60% of the time over the last 50 years. The thing that's unusual is the extraordinary level of home prices caused by keeping rates too low for too long. We've got to get back to some normalization here. Yeah. We can't just feed the economy sugar.
I know. I just think talking to so many
President Trump says he heard Fed Chair Powell will cut interest rates in September.
It's tough for them to hear about the risk of inflation because we've lived through such an inflationary shock the last few years. I mean, burgers that were $12 are now 20.
Holy
and we're talking about them going to 21, and nobody cares because they just want them to go to 12. They're not. All right, Steve Leisman is back with us. As I understand, Steve, I thought you were going into the lockup. My apologies. What do you got for us?
Well, I just want to be sure that we have the probabilities here, Brian, really echoing what you've already said, which is 68%, a touch higher for September on the probability, and 68% again, or 67.5 for December 10th, the meeting then. And then looking down the road, you're right, Brian, they remain about 100 basis points coming off. But you can see about a third of the market is not on board with this idea of a September rate cut. But in general, over time, the Fed is seen getting there to that point where tariffs pass through the system is the general belief of most of the economists in our Fed survey.
Trump says Nancy Pelosi should be investigated for insider trading.
I'm confident that's happening before it begins cutting. So I just want to come in with those numbers a little bit changed, touch higher for September on the probability of a rate cut.
But Steve, I'll go, okay, great stuff. And I'll go back to you, Steve, and ask you to maybe editorialize just a little bit here, because here's kind of the dirty secret is that the Fed can do whatever it wants to do. The question is whether the bond market listens. I'm sure you talk to people all the time about this. Even if today Jerome Powell gets on stage, takes a question from Steve Leisman, sounds very dovish, does the bond market move on that? Because the bond market maybe has its own view on where things are going.
That, sir, is an important and cogent question, if I might, and I'll tell you why. In our Fed survey, Brian, we have 100 basis points of the average respondent coming off of the Fed funds rate, and only 13 basis points coming off of the 10-year. So the 10-year is seen next year on average at ending 2026 at 425. You have a whole lot of things going on in the long end of this market. The thinking is that there will be a tremendous steepening of the curve up to maybe 75 or 100 basis points, but that you do not get the relief that people are seeking on the long end, which, as the Wall Street Journal editorialized this morning, are the rates that matter for the economy.
All right. Good stuff. Steve Leisman
Dude,
in Washington, D.C.
Anyway.
Steve,
it's going to go for it.
We know you're going to go into the lockdown now.
Brutal.
We're going to pivot in Washington, D.C. from the Federal Reserve to the White House and more data on
what a
trade,
fucking bad beat.
which also goes to the inflation story. Megan Casella, what do you got?
Who are these people?
Hey, Brian, so there's being released saying the president has signed some executive orders on trade, formalizing some moves, some of which he had threatened, some of which are new. The first is the president says he's going to be revoking entirely the de minimis threshold for all packages coming in from abroad. It'll be taking effect at the end of August. Now, this is something that will affect companies like Shein and Temu. Amazon could be exposed here. It takes away this loophole that allows small packages worth less than $800 to come into the U.S. duty-free. He says effective August 29th, all of those packages will have to face tariffs based on where they're coming from. Those country-specific tariffs will start to take effect. So that will be a big change, Brian, when that one takes effect. The second fact sheet says that the president now has formally signed that 50% copper tariff into law. That's something, or into executive order, I should say. That comes as a result of that national security investigation. He's been threatening it for a few weeks now, but we hadn't yet seen it formalized. Now he says it will be taking effect, and we can see an impact. Copper shares had been down, I think now about 19%, it looks like. So another big impact there. And then the third one, Brian, is that he also added a hefty new tariff on Brazil, something else that we had seen threatened, hadn't been formalized yet. He added 40% tariffs on top of the 10% Brazil tariffs that were already in place. He says he's declaring an economic emergency in order to do this, and that will take effect. Again, not a huge trading partner for the U.S., but there are some goods likely to see some big impact there, things like orange juice, coffee, some metals as well. So much more to come as we comb through all of these, but just coming out from the White House, Brian.
Megan Casella, thank you very much. We actually have a trade surplus with Brazil, and I guess if you wanted the price of electricity vis-a-vis copper or coffee to go higher, you'd put a tariff on those things. I don't know. So we'll see what happens. Megan Casella, thank you very much. We are just minutes away from Fed Chair Powell's press conference. Maybe get more answers on a lot of the big questions that we have been talking about here. We've got Mike Santoli coming up, Rick Santelli coming up.
Yeah,
and
give us our boy
Kyle
Rick.
Bass, not just on the Fed.
That's what we actually want.
But on China, tariffs, and this Putin guy. That's coming up.
Yeah, this Putin guy. Oh yeah, the Putin guy. All right, well, that was a pretty bad beat. Not gonna sugarcoat it, folks. That was pretty horrible. A fucking point away. We hit 60. I needed 61. Right here on this spike, I needed 61. It just needed to go up right, like just right there. Just that much. But no, the market didn't want to do that. And instead, it just vomited from 60 all the way down to 10. So it vomited 50 points. That's just phenomenal, folks. That is just phenomenal. This is what we pay for. This is what we... Dude, the sad thing is I could have done the 1 minute breakdown and that would have worked. Brother. That's a tough one. But hey, train your fingers, Matt. I mean, I was screaming as much as I could have. I was yelling at it. I was trying to get everyone all hyped up. It just didn't hit it. You got to be quick. What do you mean? The order was sitting there. It just never hit the order. The order was in. It was just off by a point, and it never got there. And here we are. A point. That's about 4 to 5 cents on the Qs. We went as high as like 569.90. If it went to like 93, 94, 95, I would have gotten the fill. I just needed a couple more cents. That would have been like the equivalent. They don't meet in August, correct. That is 100% correct. They don't meet in August. They do not. But we are missed it by a micro amount. That's funny. 5 minute, 10 minute, 30 minute, 4 hour, all bullish on ES. 5 minute, 10 minute, 30 minute, 4 hour, all bullish on NQ. The Mag 7 is climbing. The NASDAQ dropped, and now trying to hold, I guess. And then the S&P 500 up, but definitely choppy. Up but choppy. No emoji, no money. I guess that is the old cardinal rule of trading. We did perfectly tap 90, which is a big open interest level. Market is just not liking it. Not liking it. What alert did I just get? Avago?
We're certain.
Avago, new all-time high. AVGO. All right, let's get this rocking.
All right,
Let's
welcome
get
back.
this
Just
rocking.
joining us, you know the news.
Oh, shit, sorry.
Federal Reserve, no change in minutes. Michael.
off seems particularly dogmatic about how stringent the tests are going to be for seeing whether inflationary effects result from some of these tariffs, or if he's just going to
Fed
remain
governors
sort of
Bowman and Waller
non-committal, open-minded, wait and see,
dissented both
which
in
I would
favor
expect
of
the
cutting
latter
by
more than the
25
former.
basis points.
I think we're probably going to be able to just kind of get through this. What the market tells me, both in the behavior up to this point and in reaction to the decision and statement, is that this is not an economy
I was
that's
playing
really
with Piper
crying
too
out
much during lunch.
for
My
any
allergies,
great
you can see my
response to
eyes.
monetary
I'm
policy.
not
Sure,
high. I'm
all
going to
else being
clarify
equal,
that.
maybe we're a little bit restrictive. Probably want
I don't know why you guys keep asking if I'm high. I'm not
rates
high.
lower at some point, but it
Totally
seems as if
100%
cyclical stocks
not.
have been leading. Credit spreads have been very tight. Even inflation expectations, market base, have not really moved very much.
Dude, it's
Implied
gonna go
recession
right back.
odds in the market are low. So
Avago
it's kind of like the
new
market
high,
feels
this
as
shit's
if
going
we can
right
afford to
back.
wait at this point.
All right, Mike Santoli on stocks. Mike, thank you very much. Now let's go to Chicago. Rick Santelli.
Yo,
I know
our
you're the
boy
bond
Rick.
guy. I know you're the bond guy, but can I ask you about the
Trump
dollar?
ends
Because the
de
dollar,
minimis exemption for
shockingly, in a bad
global
year, continues to get
low-cost
stronger.
goods.
Well, I'm not sure I would start out with saying it's a bad year. It's a different sort of year, but the dollar index right now is going for its 5th straight higher close. It's on pace for the highest close going back 2 months, the 28th of May to be precise. So the dollar's not looking bad. And I think that makes perfect sense. As a matter of fact,
The dollar
depending
did
on
rip
how some
all
of the data
morning.
tomorrow goes,
Gave a little
dollar
bit
index
back
probably
now, but
putting
look
in a
at that
short-term
dollar
low.
rip.
If it can get a close above 100 for tomorrow, or excuse me, Friday to close out the week. Now let's start at the beginning of the curve real quick. Right now, short maturities, their yields have dropped the most, as you see on that 2-year. And if you open the chart up, and we're going to open each one up to the last meeting on June 17th. Why? Because the yields are very close to where they were then. It was at 395 then. It's at 387 now. Look at a 10-year. 10-year yields have come down a little bit less. The further on the curve, the less to the downside
The
you go.
direction
So
of
they're still a little
stripes
bit
on Rick's
elevated.
tie
They're
are a
currently at
message.
434 last Fed meeting. Day before the 17th, it closed at 439. 30-year bond's the most interesting. 30-year bond at 489 is exactly where it was on the meeting in June. Exactly at 489. And what that means to me is that there's no surprises here. The curve's going to remain rather steep, as Steve Leisman pointed out. And the big moves aren't going to happen today, in my opinion. They're going to happen after tomorrow's PCE comes out at 8:30 Eastern, after listening to what the Fed says today,
Well,
and
there
then
you
drawing
go,
conclusions after
PCE.
the inflation data tomorrow. Back to you.
Rick Santelli, always appreciate the passion and the views. Rick, thank you very much. All right, let's get now an investor's take on today's decision, but also some
Who's
other
this?
big things that are happening in the world outside of the Federal Reserve. Joining us, our friend Kyle Bass, founder and CIO of Heyman Capital Management. Any hot take, Kyle, on the Fed and Jerome Powell right now?
You know, look, I think if you look at what's driving our economy,
That
and
is
what
a
has driven it in
wild
the
hair
past,
choice,
it's really
brother.
been consumption. It's been consumers and consumption. You look at this most recent release today, consumption only grew 1% this year so far, and last year it grew 3%. So I think you're seeing the two descents that you see are the first two descents that have happened since 1993. And those descents were both focused on the
That's a
consumer
choice.
consumption behavior and labor markets. So,
That is-
Brian,
that's a choice.
With inflation running about 2.4 and short rates being 4.3% effective, the Fed is certainly too restrictive. I think rates have to come down. I think, you know, the dot plot has 2 cuts this year and 1 cut next year. I think that you're going to see more cuts than that, Brian.
All right, fair enough. And I want to move on, though, Kyle, because I got you here, and you're the global macro guy. Outside of the Federal Reserve, there seems to be a thawing in the relationship between Xi Jinping of China and President Trump. They're saying nice things. Trump is likely going to go to China. Maybe things have tamped down a little bit around Taiwan. If we get like a hug it out moment between Xi and Trump, does that add another bump to the stock market?
You know, Brian, in the end, you know where I come out on. I think that both sides, if you look behind the scenes, both sides are preparing for war over Taiwan. We are gearing up our Defense Department, our war machine, to be an effective deterrent against China's militaristic belligerence over in the South China Sea and in the Taiwan Strait. China continues to build its nuclear arsenal at record pace. It continues to build its invasion forces at record pace. And when you look at what we just did, we just enabled or allowed the NVIDIA H20 chips to go to China unrestricted into their military apparatus. And in exchange, we got some rare earth magnets that run Ford's electronic vehicles. This was a hostage swap. And this was as bad as the swap that we made with Russia, with Brittany Griner for the Merchant of Death. It was just it wasn't a smart transaction. And cozying up to Xi and trying to get some deal. I understand that diplomacy should lead here, but in the end, we are every single concession we give to China enables them to build their war machine, modernize their combat forces, and focus on, again, we give them the ability to run inference with their AI models with these chips. That's exactly what the H2O or H20 chips are for, Brian. So when we talk about what's going on with China, President Trump, I believe, wants to make a deal. But I can tell you his deal makers behind the scenes are being as tough as they can possibly be on China and giving the data to the president to make the decision.
Speaking of war, speaking of Russia, President Trump making some more threats around Vladimir Putin. I think this is maybe the underreported story of the stock market right now. Basically, you've got 10 days
threatening Putin?
to get some kind of a peace deal done with Ukraine. We're going to really, this time we mean it, enforce sanctions. Is that a hollow threat?
I don't. I know, there are a lot of people that coin the term and like to bring about the taco, right? Trump always chickens out. I would bring in the term the FAFO, FAFO here, Brian. Yeah. Look at what
we know
Trump,
what that means.
Yeah, we all know. But when you look at what Trump did with Iran, he gave a deadline and he stuck to it. When you see what he's done with tariffs, he's told people
that is
you need
true.
to make a deal with us. You don't need to escalate. We're trying to reset the trade relationship, given the U.S. being the largest deficit-producing trader in the world at about $1.2 trillion in goods annually. So I think, and now he's focusing on Russia. When President Trump draws a line, he is not going to move and he is not going to chicken out. When you look at what we can do to Russia, right now we have all the Russian banks, major banks, on sanctions, but there's still a handful of very large, call it correspondent banks of foreign entities that allow Russia to have access to the SWIFT system and move dollars around. So we can close those doors, Brian, and it will really be painful for Russia. So I would focus on the deadline, and I wouldn't bet against the president and Scott Bessent on this one.
And it all comes kind of back to what I love to talk about, of course, Kyle, and that is energy, because China has rejected calls to stop buying cheaper Russian oil. We already have sanctions on Russia and Russian oil. They kind of skirted them. They bought their own ghost fleet of ships, if we have reported on. Their record sales, by the way, of liquefied natural gas
NVIDIA's up quite a bit
to
as
Europe.
well.
Is there an economic weapon? We don't want to revert to guns. Is there an economic weapon that we can use to really solve this somehow?
SMCI's up 5%.
There is, Brian, and we have to be willing to engage in secondary sanctions, right? When we engage in primary sanctions with
it's going to do it. It's going to hit the exact level I needed. I even set the alert so I can freak out.
However, meaning in trade with the U.S. But if those entities, if it's a Russian bank doing business with a Chinese bank and enabling the commerce of that, call it sanctioned oil or gas, we have to be willing.
Powell
to
will be coming on in like 2 minutes.
The next step is sanctioning anyone that does business with a primary sanctioned entity. We have
that's everybody, though.
It's not. It doesn't get everyone. What it does is it actually puts teeth into those sanctions, Brian. And we have heretofore we have not been willing to sanction any major Chinese financial institutions. In the end, that's what's going to happen. And
Mag
so
7's
you
going.
have to remember during the Cold War. Number one, it didn't go hot because we had mutually assured destruction on the nuclear weapons side. But the way that we won the Cold War is we, along with our allies, broke Russia. The Russians didn't wake up one day
are loving
and
this.
say, you know what, democracy is a better idea. We're just going to go with democracy. It's because we took crude oil down into almost the single digits, and 60% of Russian GDP is Urals crude, and we broke them. Can we do it again? We can certainly do it again and cut them off from the rest of the world. And we can do the same with China. So I know no one wants to hear that, but I'd much rather have a financial weapon at the tip of the spear than have 5 to 10,000 of our men and women on a couple of carrier strike groups headed into the Taiwan Strait.
Yeah, I think we all would prefer that. I don't know if you, and we'll wrap it up. And again, folks, we're waiting on Jerome Powell. He may come out in 2 seconds, may come out in 2 minutes. We'd have to say goodbye, Kyle, so you'll forgive me for jumping in. Quickly, do you think the Fed has any visibility on tariffs and inflation right now?
Look, I think it's obvious that
we're waiting. We're waiting
15% across the board, and China's going to be materially worse, and eliminating that de minimis exemption. I can't tell you how important that is for the United States, and actually to combat fentanyl being shipped from China to Mexico into the U.S. and directly into the U.S. So the answer is yes. I think that the Fed certainly has a handle on tariffs. If you look at the data to date, Brian, all of the
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments.
100%.
I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a 1.2% pace in the first half of this year, down from 2.5% last year. Although the increase in the second quarter was stronger at 3%, focusing on the first half of the year helps smooth through the volatility in the quarterly figures related to the unusual swings in net exports. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles picked up from last year's pace. Activity in the housing sector remains weak. In the labor market, conditions have remained solid. Payroll job gains averaged 150,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and has stayed in a narrow range over the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in June, and that, excluding the volatile food and energy categories, core PCE prices rose 2.7%. These readings are little changed from the beginning of the year, although the underlying composition of price changes has shifted. Services inflation has continued to ease, while increased tariffs are pushing up prices in some categories of goods. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market-based and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%, and to continue reducing the size of our balance sheet. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to show through more clearly to prices of some goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation could be short-lived, reflecting a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent and that is a risk to be assessed and managed. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. For the time being, we're well positioned to learn more about the likely course of the economy and the evolving balance of risks before adjusting our policy stance. We see our current policy stance as appropriate to guard against inflation risks. We're also attentive to risks on the employment side of our mandate. In coming months, we will receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on potential revisions to our statement on longer-run goals and monetary policy strategy, and are on track to wrap up any modifications by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thanks, Chair Powell. There's a lot of lean in the markets, and not to mention out of the administration for a rate cut now in September. Is that expectation unrealistic at this point?
So, as you know, today we decided to leave our policy rate where it's been, where I would characterize as modestly restrictive. Inflation is running a bit above 2%, as I mentioned, even excluding tariff effects. The labor market's solid, historically low unemployment. Financial conditions are accommodative, and the economy is not performing as though restrictive policy were holding it back inappropriately. So it seems to me and to almost the whole committee that the economy is not performing as though restrictive policy is holding it back inappropriately, and modestly restrictive policy seems appropriate. All that said, there's also downside risk to the labor market. In coming months, we'll receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate.
So just to follow up, by coming months, does that include the possibility you'll be getting essentially 2 rounds of jobs and inflation data between now and the September meeting? Is that potentially adequate to make a decision to lower rates at that point?
So you're right. We do have, this is an intermeeting period when we'll get 2 full rounds of employment and inflation data before the time of the September meeting. We have made no decisions about September. We don't do that in advance. We'll be taking that information into consideration and all the other information we get as we make our decision at the September meeting.
Steve.
Thank you, Mr. Chairman. You took out the word or the notion that uncertainty has diminished from this statement. Does that mean uncertainty has increased? And I'm just wondering, the administration has struck several deals with large trading partners where it seems like we now know what the rate is going to be. Does knowing that rate add to your certainty to change policy, or do you need to wait to see the economic effects?
So essentially, the statement in our statement about uncertainty reflects what's gone on since the last meeting. So at the time of the last meeting, uncertainty had moved down a little bit, but it was more or less even this time. So we took out, had diminished because it didn't diminish further. So there's not really much in that. And then your second question is, say again?
There have been several deals that have been struck, and now we seem to have an idea of what the tariff rates are going to be with some of our large trading partners. Does that not add to the kind of certainty you might need, or is it you're waiting for the economic effects to show themselves?
No, I think we're still, you're right, it's been a very dynamic time for these trade negotiations, and lots and lots of events in the intermeeting period, but we're still a ways away from seeing where things settle down. We are clearly getting more and more information, and I think at this point, people's estimates, our estimates, outside estimates of the likely, effective level of tariffs is not moving around that much at this point. But at the same time, there are many uncertainties left to resolve. So yes, we are learning more and more. It doesn't feel like we're very close to the end of that process, and that's not for us to judge. But it feels like there's much more to come, as well, looking ahead.
Neil.
Hi, Mr. Chairman. Neil Irwin with Axios. This morning we got a GDP report in which final domestic private purchases decelerated, slowest pace since 22. There was a weakness in the interest-sensitive sectors and residential investment, commercial structures. Are those not signs that monetary policy is a little too restrictive right now, given current economic conditions?
So the GDP and PDFP numbers came in pretty much right where we expected them to come in. You got to look at the whole picture. So certainly, as I mentioned in my opening remarks, economic activity data, GDP, private domestic final purchases, which we think is a narrower but better signal for future, for where the economy is going, has come down to a little better than 1%, 1.2%, I think, in the case of GDP for the first half, whereas it was 2.5% last year. So that has certainly come down. But if you look at the labor market, what you see is, by many statistics, the labor market is kind of still in balance. It's things like quits, job openings, and let alone the unemployment rate. They're all by many measures, very similar to where they were a year ago. So you do not see weakening in the labor market. You do see a slowing in job creation, but also a slowing in the supply of workers. So you've got a labor market that's in balance, albeit partially because both demand and supply for workers is coming down at the same pace, and that's why the unemployment rate has remained roughly stable, which is why I said we do see downside risk in the labor market. I mean, our two mandate variables, right, are inflation and maximum employment, stable prices and maximum employment, not so much growth. So the labor market looks solid. Inflation is above target, and even if you look through the tariff effects, we think it's still a bit above target, and that's why our stance is where it is. But as I mentioned, downside risks to the labor market are certainly apparent.
So on labor, given the fluid labor supply situation, is there a number for this jobs report we get on Friday that would look to you like equilibrium job growth?
The main number you have to look at now is the unemployment rate, because it's true that the demand for workers in the form of, let's call it, just say payroll jobs, that number has come down, but so has the break-even number, kind of in tandem. So, as long as that puts the labor market in balance, the fact that it's getting into balance due to declines in both supply and demand, though, I think it is suggestive of downside risk. So we of course, will be watching that carefully.
Thank you. Colby Smith with the New York Times. Two of your colleagues called for a quarter-point cut today, and I'm wondering what aspects of their argument were most compelling to you and how you're weighing their views against those on the committee who, as of the June forecast, were in the camp of the Fed holding interest rates steady for the remainder of the year. And just in terms of the June SEP in particular, is that still the best representation of where the core of the committee is?
So on the dissents, what you want from everybody and also from a dissenter is a clear explanation of what your thinking is and what are the arguments you're making, and we had that today. So I think basically this was quite a good meeting all around the table where people were thought carefully about this and put their positions out there. As I mentioned, the majority of the committee was of the view that inflation's a bit above target, maximum employment is at target. That calls for modestly restrictive, in my way of thinking, modestly restrictive stance of policy for now. But we had two dissenters who I think, you want that clear thinking and expression of your thinking, and we certainly had that today, I think all around the table. In terms of, you ask about the June SEP, I wouldn't, that you're right, that's what it says, and that may well, I couldn't point to it 6 weeks later as expressing people's thought. You really can't do that. We don't run an SEP, and I don't like to substitute in my own estimate of what the SEP might be. We don't have one. So I'll just say that, we haven't made any decisions about September. We'll be monitoring all the incoming data and asking ourselves whether the federal funds rate is in the right place.
And just on the point about policy being only modestly restrictive, does that mean that there's actually not much scope to reduce rates once the conditions for a cut are met, barring a significant weakening of the labor market?
So let me say, my own estimate is modestly restrictive, and there are a range of views of what the neutral rate is at this moment for our economy, and so others may say it's more restrictive or less restrictive even. You know, we're going to be at some point, when we return to moving toward a more neutral stance, we'll be making that judgment as we go. I don't think we have a preset course. It's not so mechanical as saying, you know, we've derived with great confidence the neutral rate and that is our destination, because really we understand that no one actually knows what the neutral rate is. We know it by its works, and that will be how the way the economy reacts over time to, you know, to slightly looser policy.
Nick Timmeros, The Wall Street Journal. Chair Powell, my question is about what have you learned over the last few months about the inflation generating and price pass-through process? And just to drill down, the June CPI report showed evidence of tariff-induced goods inflation. Now, the tariff landscape is only starting to be settled with some of these more recent deals. Given the lags between when tariffs are announced and when they show up in goods prices, is 2 months a long enough horizon to evaluate the impact and be confident that tariffs aren't impacting the broader inflation process?
I think you have to think of this as still quite early days. And so I think what we're seeing now is substantial amounts of tariff revenue being collected on the order of $30 billion a month, which is, you know, substantially higher than before. And the evidence seems to be mostly not paid only to a small extent through exporters lowering their price, and companies or retailers, sort of people who are upstream, institutions that are upstream from the consumer, are paying most of this for now. Consumers it's starting to show up in consumer prices, as you know, in the June report. We expect to see more of that. And we know from surveys that companies feel that they have every intention of putting this through to the consumer, but you know, the truth is they may not be able to in many cases. So I think we're just going to have to watch and learn empirically how much of this and over what period of time. I think we've learned that the process will probably be slower than expected at the beginning, but we never expected it to be fast. We think we have a long way to go to really understand exactly how it will be. So that's how we're thinking of it right now.
So if I could follow up, is the reticence to look through core goods inflation being driven by the judgment that during the pandemic expectations proved more adaptive than anyone at the Fed expected? Is it being driven by uncertainty over how restrictive policy is?
You could argue we are a bit looking through goods inflation by not raising rates. You know, we haven't reacted to new inflation, but I mean, I wouldn't insist upon that. But I don't think I think the base case, as I said, a reasonable base case is that these are one-time price effects. Of course, in the end, there will not be. This will not turn out to be inflation, because we'll make sure that it's not. We will, through our tools, make sure that this does not move from being a one-time price increase to serious inflation. We want to do that efficiently, though, and that means we want to do it. If you move too soon, you wind up maybe not getting inflation all the way fixed, and you have to come back. That's inefficient. If you move too late, you might do unnecessary damage to the labor market. So there won't be, in the end, a big inflationary problem. What we're trying to do is accomplish that in a way that is efficient. But in the end, there should be no doubt that we will do what we need to do to keep inflation under control. Ideally, we do it efficiently.
Michael McKee from Bloomberg Television and Radio. The one big bill, leaving aside the adjectives, do you expect it to add stimulus to the economy in 2026? And would that be an argument for remaining on hold or cutting back on the number of rate cuts you would expect for next year?
So, of course, let me just ritual disclaimer that we don't express any judgments or anything like that on fiscal legislation or other legislation for that matter. But I would say, when you think that, you know, the biggest part of the bill was making permanent existing law on taxes, I don't think we see it as particularly stimulative. There should be some stimulative effect, but it shouldn't be significant over the next couple of years.
And to follow up, what do you, well, I don't want to put this in terms of you and the president, so let me ask it this way. Do you have concerns about the cost to the government of keeping rates elevated for longer in terms of interest rate charges?
Yeah, no, that's, we have a mandate, and that's maximum employment and price stability. And it is, it's not something we do to consider the cost to the government of our rate changes. We have to be able to look at the goal variables Congress has given us, use the tools they've given us to achieve those goals, and that's what we do. We don't consider the fiscal needs of the federal government. No advanced economy central bank does that, and it wouldn't be good for, if we did do that, it would be good neither for our credibility nor for the credibility of U.S. fiscal policy. So it's just not something we take into consideration.
Victoria.
Hi, Victoria Guida with Politico. When it comes to the renovations of the Federal Reserve's headquarters that the administration has been looking into, do you see their interest in that issue as being directly tied to the president's push to get you to lower interest rates?
Not for me to say. I will say we had a nice visit with the president. It was an honor to host him. It's not something that happens very often at the Federal Reserve to have the president come over, let alone to visit a building. But it was a good visit.
Are there any aspects of the project that they've raised that you see as making you reconsider any aspects of the project?
So, this project was hatched and conceived almost a decade ago now, and we went through the very long process of clearing it through historic preservation at the National Capital Planning Commission, and a lot of back and forth there. It was very constructive. We started out to do the work, and we're very well along on that work, and I was quite pleased to have the president say multiple times that what he really wanted to see was us getting this construction completed as soon as possible. That is our focus, and that's what we're going to do.
Thanks, Mr. Chairman. Andrew Ackerman with the Washington Post. What message do you take from the fact that inflation hit 2.1% last September and has bounced higher since? Why do you think financial conditions are restrictive and a neutral rate's below 4% when inflation has stopped falling for almost a year?
So inflation, when you talk about these 12-month inflation measures, you're always battling residual seasonality. So we'll have, for example, 2 months of high inflation sometime early in the year, and then inflation turns lower, and a lot of that may just be an artifact. So that's why we look at the 12-month numbers. I think inflation is most of the way back to 2%. There are things like the catch-up inflation. So, for example, all the insurance costs that they're only now going through inflation, but they actually reflect inflationary pressures from 2-3 years ago. So that's got to go through. In addition, now we have 3 or 4 tenths of inflation in core inflation from tariffs. So, and we can't really separate that out. We're not going to have a separate kind of inflation that isn't the tariffs. We're always going to be dealing with all of inflation. But the composition, as I mentioned, has really changed. And if you go back to the last couple of years, it was all about services inflation, which was being very sticky. Now services inflation is coming down nicely. Goods inflation was well behaved before, and now goods inflation is going up. So the story has really changed. That's partially because of tariffs. It's also partially because we had restrictive policy in place, and we've seen that the result of that gradually work its way through the services economy.
Okay, the other thing I wanted to ask is, are you comfortable that BLS can continue performing their mission effectively if they take an 8% reduction in headcount and authorized spending as the administration has proposed?
I'm not going to comment on the administration's proposal. I do think, as I've said, I think that we're getting the data that we need to do our jobs, and I think it's really important that good data helps not just the Fed, it helps the government, but it also helps the private sector. People in the economy they use this data a lot too, so it's quite important for our economy and certainly for the Fed's work and other government agencies' work that we continue to get better at data. That's what we've been doing for 100 years. We've been getting better and better and better. It's very hard to accurately capture in real time the output of a $20+ trillion economy, and the United States has been a leader in that for 100 years, and we really need to continue that, in my view.
Edward.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. How concerned are you with the data that we're coming in, showing no significant upward trend in inflation over the past 6 months, that the wait-and-see approach for inflation is actually giving companies cover to raise prices?
How concerned am I that say that again?
The wait-and-see approach is giving...
The wait-and-see approach, what do you mean by that?
For cutting rates. You're waiting to see if the tariffs will affect inflation. So it's a wait-and-see approach.
Well, so that's where policy's restrictive. When we start cutting, it'll go toward neutral.
Okay. This delay, though, where you're saying there's a one-time price increase for tariffs, which possibly could lead into bigger inflation or more inflation. Is that giving companies cover, though, to raise prices?
Well, what may be giving, it's not our policy stance, what may be giving some companies will certainly be taking advantage of the fact of the tariffs and all the discussion of how they're going to, companies will raise prices when and as they can. And you saw it famously in the first administration of President Trump during those tariffs. Washing machines were tariffed, but dryers weren't. But what do you know? The price of dryers went up too, just like washing machines. So companies will often just they'll cross the street in a group, if you know what I mean. That'll happen. We don't see a lot of that. I mean, what we see now is basically the very beginnings of whatever the effects turn out to be on goods inflation. And I'll say again, they may be less than people estimate or more than people estimate. They're not going to be zero. Consumers will pay some of this. Businesses will pay some of this. Retailers will pay some of this. But we're just going to have to see it through.
And just to follow, if I could, some additional tariffs have been in place since February, and things really haven't broken yet with the economy. So how do you justify to somebody who's looking for a house, who's facing a 7% mortgage and maybe can't afford those rates? How do you justify that?
Well, so the housing is a special case, right? We don't set mortgage rates at the Fed, right? We set an overnight rate, and the rates that go into mortgages are longer term rates, like Treasury rates. It might be 30-year rates, it might be shorter than that, but it's not the overnight Fed's rate. It's not that we don't have any effect. We do have an effect, but we're not the main effect. There are other things going on in the housing sector, and one of those is just there's kind of a long-term housing shortage that we have. We haven't built enough housing. This is not something the Fed can help with, and that'll be the case even after things normalize. So I think the best thing that we can do for housing is to have 2% inflation and maximum employment, and that's what we can contribute to housing. There are lots of other jobs to do for the private sector and Congress, but that's what we're trying to get to. We've made a lot of progress toward that. We have a very good labor market right now. Inflation, we were very close to 2%. We're seeing some goods inflation move us away, but so far not very far away.
Chris.
Hi, Chair Powell. Thank you. Well, can you give us a little more about what kind of economic data does the Fed need to see before you'll be ready to cut? I mean, do you need inflation back nearly to target? Are there other things in the pricing that you look for? Do you need to see weakening in the job market? What kind of things are you looking for?
I mean, ultimately, it could be any of those things, right? But if you saw that the risks to the two goals were moving into balance, if they were fully in balance, that would imply that you should move toward a more neutral stance of policy. This is the special situation we're in, which is we have two-sided risk to both of our goals. When we paused, inflation was above target and the labor market was pretty good. So that was a time when policy was restrictive when we paused. And to be restrictive is to be supporting a return to our inflation target, right? So as the two targets get back into balance, you would think you'd move in a way closer to neutral, and that the next steps that we take are likely to be in that direction.
Fuck?
What will it take? It'll be the totality of the evidence. As I mentioned, there's quite a lot of data coming in before the next meeting. Will it be dispositive of that? It's really hard to say. We don't make those decisions right now, so we'll have to see.
Well, I guess just in terms of inflation, though, for example, like some people would point to if it remains only in goods and it doesn't bleed over to services, then maybe that's evidence that the tariff effect is going to be a temporary one-time thing. Is that kind of thing affect your thinking, or do you just need to see the number come down closer to 2?
We'll look at everything. It's, as I mentioned, a pretty reasonable base case is that this will be a one-time price increase. And in the end, we'll make sure that that's the case. We're just trying to do that efficiently. And efficiently means getting the timing right, so we don't again, if we cut rates too soon, maybe we didn't finish the job with inflation. History is dotted with examples of that. If you cut too late, then maybe you're doing unnecessary damage to the labor market. So we're trying to get that timing right, and that's effectively what we're doing.
Claire.
Claire Jones, Financial Times. Just a question on the dollar. We've seen it decline quite heavily this year. I was wondering if there's been any discussion about that at the meetings and to what degree that might be complicating your attempts to get inflation back to target. Thank you.
So this goes back to the division of labor between the Fed and the Treasury, as you I'm sure know, and the Treasury only speaks to the dollar. It's not something that's been a topic of major discussion at all at the Fed. I won't say it doesn't come up. If the transcripts, when they come out in a few years, they'll probably reflect some mentions of the dollar, but it would never be a major focus.
And just to follow on, if I may, to Andrew's question, I think the amount of imputed data in CPI now is up to 35%. I mean, is there any discussion of that as well? Is there any consideration of looking at alternative measures, data scraping and so on, in order to just ensure you've got a good read on what's happening to prices in the U.S. economy? Thank you.
We're monitoring the situation. We do, of course, I mean, as you know, during the pandemic, we looked at a whole lot of new kinds of data. People are looking at big data sets that you can get from all sorts of places, and we do all of that. But we really need the government data. Really is the gold standard in data, and we need it to be, to be good and be able to rely on it. And we're not going to be able to substitute for that, but if we have to make do with what we have. But I certainly hope that we get what we need.
Jay O'Brien.
Hi, Mr. Chairman. Jay O'Brien, ABC News. President Trump has obviously invoked your name a lot. He has personally pressured you. Are you concerned the way that conduct might impact the Fed's independence going forward?
I'll just say that, I think that having an independent central bank has been an institutional arrangement that has served the public well. And as long as it serves the public well, it should continue and be respected. If it didn't serve the public well, then it wouldn't be something that we should just automatically defend. But what it gives us, and other central banks, what it gives you is the ability to make these very challenging decisions that in ways that are focused on the data and the evolving outlook, the balance of risks, and all the things we talk about, and not political factors. And so governments all over the advanced economy world have chosen to put a little bit of distance between direct political control of those decisions and the decision makers. So if you were not to have that, there would be a great temptation, of course, to use interest rates to affect elections, for example. And that's something that we don't want to do. So I think that's pretty widely understood. Certainly it is in Congress. And I think it's very important. I'll just say that.
Maria Eloisa.
Afternoon, Chair Powell. Maria Luisa Capurro from Bloomberg News. You mentioned a slowdown in consumer spending, and I wanted to see if you could walk us through what was the discussion with the committee around that. We've seen delinquency rates rising for upper-income households. How do you see that evolving in the next few months, and how much of a vulnerability that is for the economy going forward?
Consumer spending had been very, very strong for the last couple of years, and had repeatedly, forecasters, not just us, had been forecasting it would slow down, and now maybe it finally has. So I would say, if you talk to credit card companies, for example, they will tell you that the consumer's in solid shape and that spending is at a healthy level. It's not growing rapidly, but it's at a healthy level, and delinquencies are not a problem. You mentioned high-end delinquencies. I don't know what to make of that. I read the same thing. But so generally, and if you look at the banks, and when the banks talk about in their earnings calls, the performance of credit has been good. So essentially, you have a consumer that's in good shape and is spending, not at a rapid rate. But it's true, and it was, again, right in line with what we expected, the GDP data that we got this week. And I think it's still a little bit difficult to interpret because you have these massive swings in net exports, which may also be affecting, some of that can affect consumer spending as well. Look, it's one of the data points that we pay most careful attention to, and there's no question that it's slowed. And we're watching it closely, but we also watch the labor market and the performance of inflation. Those are our two variables that we're assigned to maximize.
And just to follow up on what my colleagues were asking about this sense, Governor Waller said that the labor market is on edge, and he was pointing to weaknesses on the private sector. I was wondering, you've said that the main number to look at is the unemployment number overall, but what was the discussion about the state of the private jobs market?
So I'm not going to talk about any individual's, any individual's comments. I wouldn't do that. But look, I think what we know is that private sector job creation, certainly in the last report we'll see on Friday, but had come down a bit. And if you take the QCEW adjustment seriously, it may be even lower, maybe close to zero. But the unemployment rate was still low. So what that's telling you is that demand for workers is slowing, but so is the supply. So it's in balance, oddly enough. You've got a very low unemployment rate, and it's kind of been there for a year as job creation has moved down. But also we know that because of immigration policy, really, the flow into our labor force is just a great deal slower. And those two things have slowed more or less in tandem. If you look at things like I mentioned, quits, look at wages. Wages are gradually cooling. Look at vacancies to unemployment. Those things have been pretty stable they haven't really moved a lot in a full year. So I think if you take the totality of the labor market data, you've got a solid labor market. But I think you have to see that there are downside risks. You don't see weakening in the labor market, but I think you've got downside risks in a world where unemployment's being held down because both demand and supply are declining. I think it's worth paying close attention to it, and we are.
Nancy.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. One more question on the lack of unanimity in today's decision, the two dissents. Was there talk during the meeting? I know you're not going to talk about exactly what individuals said, but in general, was there talk during the meeting of cutting rates, and what was the case against that at the meeting?
Sure. So we have an economic go-around where people talk about the economy, and then that's yesterday, and then today we have a monetary policy go-around all the way around the table. Everyone gives their views. So the discussion around policy was the majority view was still what it has been, which is that inflation's running above target, maximum employment is right at target. That means policy should be a little bit restrictive, somewhat restrictive, because we want inflation to move all the way back to its target. So that's where people have been and still are. Two of our members felt that the time had come to cut, and that they, for the reasons that they're going to express. I won't tell you the reasons they'll issue some kind of a thing in the next day or so. So, but that's the story, and I would say, you know, well argued, very thoughtfully argued all around the table, good arguments, and you know, it's a situation where unusual situation. The economy is in you know, good shape, but it's an unusual situation where you have risks to both your employment mandate and your inflation mandate. That's the nature of a supply shock, and it's probably not surprising that there would be differences and different perspectives on that, as well as different views of where the neutral rate is, so that different views of how tight policy is. So we have those. I will say what you hope is that people, you know, explain their positions very thoughtfully and clearly, and we absolutely had that today, all the way around the table. I would call it one of the better meetings I can recall from that standpoint.
And you've said you're waiting to be confident inflation is heading toward your 2% target before you start cutting rates. When you do get that confidence, would you be in favor of lowering rates right away?
It's not quite the way I would put it. You know, I said that's why we think policy should be restrictive, is because, you know, inflation is above target. When we have risks to both goals, one of them is farther away from goal than the other, and that's inflation. Maximum employment's at goal, so you have to. That means policy should be tight, because tight policy is what brings inflation down. If you came to the view that the risks to the two were more in balance, that would imply that policy shouldn't be restrictive. It should be more neutral, more you know, a neutral stance, and that would be somewhat lower than where we are now. No one knows exactly where that is. So that's the framework I think I'd be taking, and you know, we'll just have to see. We're going to be obviously looking at a lot of data in the next cycle. It is one of the cycles where we have 2 employment and 2 inflation reports, and we'll see where that takes us.
Jeff Cox.
Thank you, Mr. Chairman, for taking the question. Jeff Cox from CNBC.com. A metric that you like to cite a lot is the final sales to private domestic purchasers. That was down to a 1.2% gain in second quarter from 1.9% in Q1, suggesting that there's some softening in underlying demand. I just wondering if you look at that and you combine that with some of the housing numbers, the weakness that you acknowledged at the top of your remarks, that the housing market is in fact weak, and the inflation numbers from GDP today came down to 2.1% for headline, 2.5% for core. I'm wondering how much more movement you would need to see from these data points before you would be comfortable with cutting in, say, September.
It's going to be the total. Hard to answer that specifically. PDFP, I think, for the first half, private domestic final purchases, or final sales, as people call it, was 1.6 on the first half. GDP, I believe, was 1.2%. That's the whole half. You mentioned the quarters. So those are slower, but you know, GDP is bumpy quarter to quarter, half to half, and often gets revised, you know, after the fact. The labor market data we still think is, continue to think is the best data we have on the economy, and that shows a 4.1% unemployment rate. It shows wages, you know, still at a healthy level, but moving ever closer to what we would regard as long-run sustainable, consistent with longer-run productivity and 2% inflation. So the labor market is actually still quite solid. Inflation is above target, even ignoring tariffs. It's a little bit above target, and tariffs. So we're watching all of that, and again, trying to do the right thing in what is a challenging situation, because you're being pulled in 2 directions, and you have to decide which of those to go in. And actually, at some point, if they're sort of equally at risk, then you really want to be at a neutral policy stance, which we're not right now.
So it'd be safe to say that if the data kind of stays in line with where it is right now, that you wouldn't be comfortable with cutting in September?
I'm not going to say that. No, I just think we're going to need to see the data, and it can go in many different directions. The inflation data and the employment data, and we're going to make a judgment based on all of the data and based on that balance of risks analysis that I mentioned.
Thank you.
Greg, Rob, for the last question.
Thanks, Chair Powell. Greg Robb from MarketWatch. The Treasury Secretary has said recently that it would be confusing for the markets if you stayed on as a governor after your term as chair ends. And I was wondering if you had any update for us on a decision on that front.
Sorry, I do not have any update for you. Thanks very much, everyone.
Thank you very much, everyone. Well, that is all she wrote, folks. Let me clean this up. Let me get rid of that. That is all she wrote. The market liked it at first. If I was a little bit earlier, a little bit later, I would have gotten my fill, but I got demolished, as you guys saw. And it went to my level anyway. Like I said, a little earlier, a little later, I would have been fine. Off by a fucking point. That's gonna make me stay up tonight. I could tell you that for sure. But anyway, market popped a little bit. We dropped. Most likely, we dropped due to how willing Jerome Powell seemed to not cut rates, even at the September meeting. I guess it is what it is. Right now, I would say don't judge something holistically on short-term movement, because we had 20 minutes of popping, 30 minutes, 40 minutes of severe puking, a little bit of a recovery right now. So, like, just because you see these 3 red bars, that's not like an opportunity to really fucking scream, because we hit an all-time high yesterday. Like, literally hit an all-time high yesterday. So this idea of, like, I'm so sick and tired of, like, doomsday people talk. Like, literally the high was in yesterday. So if you're freaking out because of 30 to 40 minutes of a sell-off, just remember we hit an all-time high yesterday. So, like, I think sometimes when in doubt, zoom out, understand where we've been, where we're going, take in the larger picture to have a better understanding of what this is. And just more from an anecdotal standpoint, we've seen this kind of stuff in the past where there's like a dramatic reaction on Wednesday. Remember, it's not necessarily like a given that we just don't completely bounce back tomorrow. Of course, it can continue, but it's not out of the question that this is just a fake out. It's bought up in the overnight session, and before you know it, we're back at the all-time high. So, like, to have an emotional response to this, I would say it's just it's inappropriate. As always, we are not here to try to predict, does this bounce, does it puke, what does happen? Just react. React to the breakouts and the breakdowns, the fake out breakouts and the fake out breakdowns. React to the options flow. Your goal is to wait for a certain set of data to all align in one direction and take advantage of that with ideally a low risk setup. That's the name of the game. Your name, the name of the game is not for you to try to predict where this is all going to go. It is not whatsoever. If you're doing that, it is a very, very fast way to basically just lose money, to be completely honest. So that's where we're at for right now. Like I said, we are dipping right now, but the larger context is we just hit an all-time high yesterday. I do want to remind everyone that tomorrow, or there's 2 things I should remind everyone about before I let you go. So hang on for 1 second. Give me an extra 3 minutes of your time. After the market closes today, Meta, Microsoft, Robinhood, Carvana, Lam Research, Qualcomm, Ford, ARM are all reporting. Lots of movement post-market today. What is this one? And then tomorrow, Apple, Amazon, Strategy, Coinbase, Reddit, Riot, Cloudflare, Roku. So big tech names today, big tech names tomorrow. And then between the ones tonight and the ones tomorrow, we also have a PCE inflation report tomorrow coming out an hour before the market opens, 8:30 a.m. ET. So pay attention to that as well. So macroeconomic data tomorrow morning, earnings tonight and tomorrow night. So tonight, tomorrow morning, tomorrow night, and well, Friday, we are in the middle of earnings season. So a lot to consider, a lot to digest, as always, in these types of moments, especially when we're at highs with so much positive gamma and such low vol. Don't swing for the fences. This is not the environment to going full bore, all calls, all puts, YOLO, zero DTs. There's no expectation for range. Right now, the movement is very, very muted. There's a lot of positive gamma in the overall system. This is not the time to be slinging it. It just isn't. If anything, it's a time to be getting your little future scalp trades in. It's a time to be selling premium. We just don't have the ingredients for the recipe that we currently need for a big movement. We just don't. It's not there. I wish it were there. It's just not. So pay attention to, obviously, the market close today. Pay attention to all those earnings. Pay attention to the inflation report tomorrow morning and the earnings. And then some of the biggest companies are reporting after the market closes tomorrow as well as today. So obviously, be prepared for all of that as well. Folks, that's what I have for you. Before I let you go, don't forget to sign up for Public. It's 100% free to download it. Check it out. No commission fees, no per contract fees, and you get paid a rebate every time you trade options. Use that link pinned at the top of chat and in the description of the video. That's what I have for you. I hope you survived that onslaught. I hope you got at least a little bit luckier than I did. And that's what I have for you. I will catch you tomorrow morning. And then we're going to see if we can make some of the money back that I ended up losing today. So it should be a fun one. That's what I have for you. Thanks for all the good vibes. Peace.